Your credit score is not a measure of your financial health. It is a measure of how profitable you are to lenders. Those are not the same thing, and the difference between those two definitions will cost you hundreds of thousands of dollars over your lifetime if you never understand it. Welcome to Margin of Empire. This channel exists for one reason: to show you how money and power actually work. Not the version they handed you in school, the real version. Let us start diving deep into today's topic. Here is what your credit score actually measures. It measures how much you borrow, how consistently you pay back, how many different types of debt you carry, how long you have been in debt, and how recently you applied for more debt. Notice what is missing: your income, your savings, your net worth, your assets, your actual financial health. None of that matters to your credit score. A person with zero debt, full emergency fund, 6 figures in investments, no mortgage because they paid cash. That person has a terrible credit score. And a person drowning in credit card debt, car loans, student loans, personal loans, making minimum payments every month, that person has an excellent credit score, because the score was never designed to measure wealth. It was designed to measure credit behavior, specifically behavior that benefits lenders. Here's where it came from. Before credit scores existed, lending was personal. A banker knew you, knew your family, knew your business, made judgment calls. That system had obvious problems. It was biased. It was inconsistent. It favored people who looked a certain way. So, in the 1950s and 1960s, engineers Bill Fair and Earl Isaac created a mathematical model to standardize lending decisions: FICO, Fair-Isaac Corporation. The idea was noble: remove human bias, create an objective measure. But here's what happened instead. The model they created did not measure financial health. It measured credit behavior, specifically behavior that benefits lenders. And once the major banks adopted it, and the 3 credit bureaus, Experian, Equifax, and TransUnion, built their entire business around it, the system became self-reinforcing. To have a good score, you must borrow. To borrow well, you must keep borrowing. To keep a high score, you must remain in the debt ecosystem permanently. Here's how the score actually works. 35% is payment history. Pay your debts on time. Simple enough. 30% is credit utilization. How much of your available credit you are using. Keep it below 30%, they say, which means you need available credit to have good utilization, which means you need credit cards and loans just to maintain the score. 15% is length of credit history. The longer your accounts have been open, the better. Close an old card, score drops, even if you paid it off perfectly. 10% is credit mix. They want you to have multiple types of debt: credit cards, installment loans, mortgage. The more variety of debt, the better your score. 10% is new credit inquiries. Apply for too much at once, score drops. Read that back slowly. To have the perfect credit score, you need to have borrowed money for a long time, be currently borrowing multiple types of money, be using some but not too much of your available credit, and not be applying for too much new credit right now. The perfect credit score requires you to be a perfect long-term debt customer, not a financially free person. A perfect debt customer. And here's what this score controls. Your mortgage rate. A difference of 1 point in your credit score can mean the difference of 0.5% on your mortgage interest rate. On a $400,000 home loan over 30 years, that 0.5% is approximately $47,000. Your car loan rate, your credit card interest rate, your insurance premiums in most states, your apartment application, your employment application in some industries. Your landlord checks it, your employer checks it, your insurance company checks it. One number, created by a private company using a methodology they don't fully disclose, controls your access to housing, transportation, employment, financial products. And the only way to keep that number high is to remain a loyal debt customer forever. Here's the irony that should make you angry. The people who need credit the most get the worst rates. The people who need credit the least get the best rates. A wealthy person with multiple assets and high income gets a 3% mortgage because their score is perfect from decades of managed debt. A young person with no debt history trying to buy their first home gets a 7% mortgage or gets denied entirely. The system punishes financial inexperience, rewards debt experience, and calls it objective. So what do you actually do with this information? First, understand the game before you refuse to play it. The credit score system is real. Its consequences are real. Pretending it doesn't exist costs you money. You need a functioning credit score to access the basic financial infrastructure of American life: mortgage, car, apartment, sometimes employment. So play the game, but know what game you are playing. Second, build credit strategically, not emotionally. 1 or 2 credit cards paid in full every month, never carrying a balance, long account history, low utilization. That's all you need for an excellent score without paying $1 of interest. Third, don't let the score become your financial goal. A high credit score is a tool, not a trophy. The goal is financial freedom. The score is just one instrument you might need along the way. Fourth, understand what the score does not measure. It does not measure your savings rate, your investment returns, your net worth, your financial resilience. The score is a single dimension of a multidimensional financial picture, and it's the dimension most useful to lenders, not to you. The credit score is not your enemy, but it's not your friend either. It's a tool designed by lenders for lenders that you happen to also need to function in the modern financial system. Use it, don't worship it. Because the person with the perfect 850 credit score who carries balances every month and pays minimum payments, that person is making the bank very happy and getting nowhere. If this changed the way you think about credit, hit subscribe. This is what we do at Margin of Empire every single week. We pull back the curtain on the financial systems and advice that shape your life, without the jargon, without the spin. Watch this next. It connects directly to everything we just covered. Drop a comment below and tell us, did you know your credit score does not measure your wealth? And does knowing that change how you think about it? Don't let the algorithm decide what you learn next. You do.